I'm Yulia Yani, co-founder and CEO of Realatom. Realatom is an industry-leading lending-as-a-service technology that powers commercial real estate lenders like banks, credit unions, and non-banking organizations to make more commercial real estate loans. We're starting a series of podcasts interviewing users of our platform, and most of them are industry experts. They've been in commercial real estate lending or commercial real estate finance for a long time, and they definitely have something to share with all of you. And today, I am pleased to introduce my, I would say, friend. I hope, Andy,
Yes,
I can
do.
call you that. Andrew Weiss. Andy is a founder of Sapphire Capital Group, is a boutique real estate capital advisory firm based in Bethesda, Maryland. Andy, welcome.
Thank you, Yulia. I appreciate you having me as your first guest, and you are a friend.
Thank you. Well, let's just dive into it. Please tell me about your career because I find it absolutely fascinating.
Thank you, Yulia. I appreciate that. So I started my career back in the late 80s after graduating from business school, where I went to MIT Sloan School. I took a job with the Prudential Mortgage Capital Company, part of the Prudential Insurance Company in DC as a lender. So started my career as a lender with Prudential. And I have worked for a shopping center owner, which was a borrower of mine at Prudential, and ended up going with them when they went public. And I was the analyst that handled acquisitions, refinancing debt, and also I was the analyst when the company went public. So I sat in the seat between the CEO and the investment bank, running the model to take the company public. Was an interesting experience to have at a young age. And in between, I worked for a private equity firm, CIM Group, which a lot of people know. That's a national private equity firm that invests in all sorts of real estate deals, development deals. And I was the firm based in LA. I was here on the East Coast, and I was with them during the recession. So spent a lot of time acquiring distressed debt, and then at the end of that, ended up refinancing most of CIM's portfolio. Worked for a large national mortgage banking firm, Meridian Capital, where I ran a DC office and worked on raising debt and equity on deals all over the country. That was in the early 2000s, and did lots of JV equity development deals for large projects in DC, but also, as I said, worked on deals all over the country. And that was sort of structured finance and capital raising, and also ran a group that did multifamily loans, which is something that Meridian Capital is well known for. And ended my career employed career working for Cantor Fitzgerald as a lender. And that was the time frame which Cantor Fitzgerald ended up acquiring Berkeley Point, which is a big multifamily Fannie Freddie lender. So I was in the office with Berkeley Point, but I was originating CMBS loans for CCRE, which was the Cantor Fitzgerald subsidiary. So I've sat on as I say to people, I've sat on all sides of the table. So I understand what it means to be a borrower, having been a borrower, and understand what it means to be an acquirer of real estate, which I've done. And really, I feel like my strength was from all those names I listed and going to conferences for 30 years. My really strength is that I'm a relationship person, and I've developed some very powerful relationships, ranging from high net worth individuals, family offices, and then sort of larger institutional owners and equity sources. So by the time I left my last employment, I felt like I had a pretty powerful Rolodex, and I might as well decide to work for myself and help my relationships and clients acquire properties and recapitalize properties.
That's an amazing career, and it's a very, very logical conclusion for you to move from working for some of the largest companies in the industry to starting your own firm. So please tell us about Sapphire Capital Group.
Yeah, so Sapphire Capital Group is a real estate finance company all really seasoned professionals, and we take on assignments to raise debt and equity for what I call owners and developers. So people, that acquire and own real estate, or people that do ground up development. And we typically take on assignments where raising the debt and the equity, and sometimes that ranges from multifamily situations that are with Fannie and Freddie. So I work through one of those advisors. Other times it's bank debt and JV equity, and again, larger deals are really institutional equity sources, and smaller deals might be family offices or high net worth individuals.
Andy, thank you. And I just want to mention to our listeners that I invited Andy for a reason. Sapphire Capital is doing some amazing deals, and stay with us because Andy is going to tell you everything about it. But meanwhile, please, Andy, tell us about some of your most interesting deals that you have closed in the past few years.
Okay. First deal that comes to mind is a $90 million acquisition in North Carolina of three separate multifamily projects. So that was a sponsor that I met that was acquiring three projects that were all in the same submarket, and we took on the assignment to raise literally all of the capital. So we went to Fannie and Freddie and got quotes, and ended up doing Fannie Mae debt on the three properties. Then we found a joint venture equity source that put up 90% of the equity, and combined in all of this was a sponsor that really didn't have the wherewithal to do a deal that was that large. And we ended up we ended up bringing a high net worth individual who became a co-GP with the sponsor. So that person both signed on the debt and contributed, more than half of the GP capital. So, good properties, good market, relatively large deal. The sponsor needed help raising capital, and we're very active. So we took on the assignment of, putting the numbers into our models and helping present the deal to all the different audiences. So that's one deal that, where we'd raised probably 98% of the capital. Another deal, a little bit different, was a relationship I had from one of my prior, employers, and someone that had left a private equity firm, moved to Florida, and I started by helping him recapitalize a couple student housing deals, and that was more of taking on the assignment and going to family offices and high net worth individuals. Then that same client ended up forming a nice relationship with one of my high net worth individuals, and the client calls me one day and has a chance to acquire about 20 acres of land, needed to close quickly. So I got this high net worth individual to put up the bulk of the capital. That started a relationship on this particular deal where the property had to get entitled and planned to develop a 400 unit, probably a $80 million multifamily project. So then we went out and did a JV equity deal, and this particular investor, has stayed in the deal, continues to be in it today, and going from the land acquisition to the entitlements to the construction. So again, a lot of my theme is just because I've been in the business so long and I've gone to conferences and I'm a social guy and keep in touch with people, I've got pretty powerful Rolodex of both owners and developers, and then on the capital side of starting with lenders to high net worth individuals, family offices, and growing to the big institutional equity sources. So those are two recent deals that were stressful, interesting, but very successful.
Andy, thank you for sharing. It seems like you are used to working on complex transactions and structuring complex financing deals. But before we move to the next question, please do tell us about the guitars.
Yeah. So
I couldn't resist asking you.
Yep. No, the guitars. The guitars are my crowd pleaser for my Zoom calls. So I've played guitar since growing up in New Jersey in high school, and this one is a PRS. So this is my favorite one and have a bunch of guitars and still play in a band. And unfortunately, in COVID, playing at home a lot more than playing out. But hopefully that'll end in 2021, and I'll be playing at my favorite spot, Old Anglers Inn, where we're sort of the pseudo house band.
So tell me, which one is a Porsche, which one is Ferrari?
Yeah, no, the PRS is probably the Porsche, and the Robin on the other side is probably the BMW.
Got it, got it. Thank you for sharing.
Absolutely.
So now let's talk about the very interesting thing that your company does that I understand not many people in the industry do. So please tell me about your expertise with ground leases.
Yes. Okay. So I'm excited to talk about this. So the ground lease capital, well, first of all, ground leases have been around forever. So it's not that ground leases are new, but sort of the way CMBS changed, and people call it CMBS 2.0, when all the rules changed and the underwriting became more onerous and more structured. Same thing with ground leases. Ground leases now have become more popular. There's one public company that has done a lot to educate the industry. It's a company called Safehold, and we've done a couple deals with them. But basically, in probably 2017, we took on an assignment on $100 million multifamily acquisition in DC. And the client had a $67 million loan application from Fannie Mae. So he needed $33 million of equity. And although it's a good client and it was a good property, it was hard to raise equity. DC is very competitive. It was a very expensive purchase. So he was having a hard time raising the equity. So my phone rang, and he asked me to help him with the project. And what we did, which was different, was we broke the investment into two pieces. We brought in a $40 million ground lease investor. So that left $60 million, and I'll come back to that. That left $60 million to raise. And we went back to Fannie Mae, and they agreed to lend 42. So now all of a sudden, big picture for the client, it went from a $33 million equity raise down to an $18 million equity raise. And because of the math and the way the numbers work, which I'll explain, the returns went up from roughly a 5 cap on buying it as a fee simple property to roughly a 5.6 cap of buying it as a leasehold with the ground lease investor. And so that made it all fall in place. And then I continued dialing for dollars, and we helped them raise the equity, and we closed. And that was sort of the first large, big ground lease deal I did. But a couple things I learned from that process. The just simply the idea of reducing the amount of equity that the sponsor needs, is a huge game changer. So if structured properly, which knock on wood, we've learned how to do, and we know how to do, and we've built our own powerful Rolodex with ground lease investors, you can reduce the amount of equity that the sponsor needs, and you can increase his returns. So again, back to the first deal, the $40 million ground lease investor, that amount came in, properly structured. So we were still able to get a Fannie Mae loan, and all of the combination of the ground lease investor and the Fannie Mae loan got the sponsor up to roughly 82% leverage, and made the returns go from a 5 cap to a 5.6 cap, and that allowed him the ability to raise the equity, where otherwise, without this ground lease investment, he probably would have struck out, and he was having a hard time raising the equity.
This, this is amazing. As you know, a lot of people reading our blog, and I hope a lot of people will be listening to our podcast. So I am sure your phone will start ringing nonstop, because reducing the equity investment from 33 to 18 million, this is an amazing benefit for the sponsor. So can you explain how the ground lease capital works?
Yes, I can. So it's typically a transaction where the ground lease investor is brought in. They acquire the land, and they enter into a 99-year ground lease with the sponsor. And the couple factors that go into that is they negotiate the amount of the ground lease investment, and that's typically based on two stats. One is the coverage, so the NOI from the property divided by the ground rent. You want that to be at least 3 to 1. So In this case, remembering the numbers, the NOI was roughly $5 million, and the ground rent was about $1.4 million. So you had a very safe, comfortable relationship between the NOI and the ground rent, and the ground lease investor is going to view it as a AAA bond. So they're going to know that things would have to get pretty bad for the sponsor to be defaulting on the ground rent, and they pretty much can put this investment to bed. It's a passive investment, and it's going to be paying interest like a bond. The other couple and so you typically want the NOI to ground rent to be at least 3 to 1, and in this case, the ground lease investment was just under $40 million. The total property was worth 100, so less than 40% of loan to value of the ground lease investment divided by the fee simple value of the property.
Let me ask you, what are the benefits to the sponsor of using this strategy, and what kind of sponsor should use the strategy? Basically, who should call you, for your help with ground leases?
Yeah, it really applies. It really applies across the board, because the example I'm giving you is for an acquisition. So it works great for an acquisition because it reduces the amount of equity that the sponsor needs to bring to the table. It also really works really well for a recapitalization. So if a sponsor owns a property and they're thinking of raising money for another deal, the recapitalization of a property with the ground lease capital and the leasehold debt can all come out tax-free. So it's also a great way. I tell lots of wealthy owners that they should consider this if they're going to go do a development deal. It's harder to raise money for a development deal if they own existing properties that they can recapitalize. It can work great to recapitalize an existing property. And as I said, it also has good tax benefits because the ground lease capital plus the new leasehold loan can all come out tax-free and not trigger capital gains tax. So there's also a whole tax side of this, which is advantageous for the sponsor. And then on development deals are harder, but we also did it on a development, we've done it on many development deals, but we did a large development deal in DC where the sponsor was developing it was a $125 million budget. And, they were putting together the different players, and it made sense for them. It was a $30 million ground lease investment as part of the whole $125 million budget. So that worked out great.
That's very interesting, and it does sound like it's very beneficial for different owners. Let me ask you, this year was a very strange year for the industry. And you have your own company, you have people that you're responsible for. How did it go for you? I heard that you still been very, very busy this year. Please tell us.
Yeah, no, it's been again. I have had through my years of business, and then on the personal side, the year's been challenging for everyone, and so I'm sympathetic to everything that everyone has gone through, and hopefully people listening to this podcast are healthy and are doing what I'm doing, which is staying home and have all my kids at home, and although we're all a little house crazy, pretty much have been staying in. But on the business side, what we just talked about, reducing equity and raising money during COVID has been hard. And my niche actually has been very helpful for lots of people that we talk to and that we've closed deals with. And when I say that, I mean, the lending community, which I'm very, very close with, they've all, in March, they shut down, and it was very hard to get a loan on anything because everybody was trying to understand, triaging their existing portfolios, and we can understand why. And, each property type, starting from the worst, hotels and retail, probably were the hardest hit. And then, but across the board, Fannie, Freddie, everyone across the board, was having problems. So first thing I will tell you is, going back to what I said earlier in this discussion, my networking, I went to NMHC my two last conferences were the MBA in San Diego and NMHC in Orlando. And just through connecting with people at NMHC in Orlando, I told a large public company about my ground lease niche, and they explained to me that they probably don't need my capital because they have enough capital of their own. But why wouldn't he introduce me to the investment sales brokers that sell his properties or potential buyers? Because those people could probably be able to pay more if the ground lease capital worked for their particular deal. And again, it doesn't work for every deal, but for deals when it works, it can be very powerful. So we were at the right place at the right time. 2 weeks after NMHC, I'm following up with that public company, and they're getting me on the phone, and I'm walking them through a couple examples of properties they're going to sell and explaining how the ground lease capital could work. And 2 weeks after that, COVID hit, and he calls me and says, "Listen, I have a large DC Metro project under contract, and my buyer, although he's unbelievably successful and well known, is having issues." So 2 Zoom calls later, I was able to help a large multifamily owner in the DC region close on a $280 million multifamily acquisition by bringing in $90 million of ground lease capital, structuring the ground lease capital so it could be financed with a Freddie Mac loan. So we closed a $90 million ground lease capital, $125 million Freddie Mac loan on this 500 plus unit project in DC that closed end of the second quarter in 2020. So closed June 30th. Great deal, great for the sponsor, wonderful relationship. And again, the ground lease capital deals are complicated because the ground lease has got to be tweaked and modified, in this case, really to accommodate and to work with the issues that Freddie Mac had with it. And, myself and my team are experienced, and we were able to do what we needed to do so that the ground lease capital could be used, in this case, to significantly reduce the amount of equity he needed to close. And then the other deal, nothing to do with ground lease capital. The other deal was a pre-COVID $95 million CMBS loan that I had in process when COVID hit. Unfortunately, the CMBS market, shut down during COVID, and I had picked a good, CMBS lender. We kept in touch, kept doing weekly calls, and once the market opened up again, other than a couple tweaks to the structure, we were able to close that in July. So I had 2 large deals close, and we've been very busy. I have a pref equity deal I'm closing for a sponsor on a property in Florida, and have a portfolio of apartments in Texas that I have a term sheet for JV equity. So not everything we do is ground lease capital, but ground lease capital is definitely my niche and the thing that I'm very focused on.
Andy, why not many companies in the industry do ground lease? What makes you, so special that you focus on that, or it is your niche?
Well, I can make fun of myself with my age and my experience, but it is a little harder to structure. It's not that it's complicated. It's just that you have the different participants in a deal, and ground leases did get a bad rap and had some problems. Again, I'll call those ground leases 1.0. Lots of wealthy owners in the U.S. Because I'm from New York. I guess I'm wearing my Yankee shirt today because I'm from New York and know some examples there. Lots of wealthy owners in New York would say to the acquirer, "I'm not a seller. I'm not a seller," and eventually would say, "Okay, I'll ground lease you my land, and you can build something on it." And many of those, not everyone, but many of those ground leases had things like ground rent resets and land appraisals. So the ground lease would include a provision that would say, after year 30, we're going to appraise the land, and the ground rent is going to be blank percent of the new appraised value of the land. We don't do things like that. Our ground leases are structured so you're going to agree on a year 1 ground rent. It's typically going to have an annual escalation, 2 to 3%, and the ground rent is going to go up each year. So the answer to your question, why do some people not? Well, why isn't ground leases used as much? Is that unless they're structured properly, they can create problems, and a lot of the people that are in the industry remember the problems that happened as a result of ground leases. Also, from the equity investor side, there's a couple things. Many of these large institutional funds raise billions of dollars these days. So they don't necessarily want to reduce the amount of equity. They may prefer to do it the old-fashioned way of just put in, 40% equity and go get a 60% loan, and that works perfectly. Why change it? And there's something to be said for that. If you're sitting on $5 billion of equity and you're the equity investor, you can decide. Everyone can be selective and decide what they want to do. So I respect that. But I do think for the sponsor, if structured properly, reducing the amount of equity is probably the biggest factor to help the sponsor make more money. And most of my sponsor relationships and borrowers and owners care about making money, and they want to figure out how to put in less equity and get to the promote or get to their returns quicker.
I think you just said the magic words for the sponsors. Basically, less equity,
higher
more
profits.
Returns.
Correct.
And that's your expertise.
Correct.
And a lot of connections in the industry.
Yep. I mean, one other thing I didn't mention yet on the call that I should mention is because we work on deals across the country, some in primary markets like DC, New York, San Francisco, but we also do secondary market deals. So we've done a deal in Fort Myers. We look at deals in Richmond. I have a deal in Philadelphia now. I have a deal in Jacksonville. So we've expanded our relationship of ground lease investors to family offices and smaller investors, because not every deal is going to be a $90 million ground lease. We've done $20 million ground leases. And another thing that we've been able to do is negotiate what I call a repurchase option. So that is a game changer for a lot of people. Is they get scared if I'm going to sell my land and my ground rent is going to go up every year. Eventually, it could become a problem where the ground rent has escalated to an amount that makes it hard to finance the property. So one of the things that we've been successful at is negotiating a repurchase option for a sponsor, which means they're going to close on a 99-year ground lease, but they're going to have a one-time right in year 25 to buy back their land at a pre-negotiated formulaic price. So, and every deal is different, and every deal sort of has their own nuances to it. So it's not really one size fits all. Each deal is sort of unique. But the couple things I've mentioned on this call, allow us to be very confident that on a real estate deal that makes sense, we can figure out how to use the ground lease capital to reduce the equity and improve the sponsor's returns, and make it good for both sides. And we have a pretty powerful Rolodex of ground lease investors that will do retail deals, office deals, multifamily deals. Pre-COVID, there was a lot of ground lease investors that loved hotels, because hotels typically, the daily rate and the hotel occupancy is going to go. The hotel rate is going to go up with CPI, and so they love the idea that the ground rent increases are going to be offset by the increase in the NOI from the hotel, which is typically going up with CPI.
Indeed. Thank you so much for sharing with us your expertise. And I'm sure a lot of people that right now are looking for more returns on their deals will be very interested to listen to this podcast. And I'm sure you guys will get a lot of calls. It's just because I love hearing about those specialties within the industry, because you cannot do everything for everyone, but when you're doing something so great, it can benefit a lot of people. And I understand that it's beneficial not only for the sponsors, but for the people who are interested to invest in those ground leases.
Well, thank you, Yulia. Thank you for having me. I appreciate it very much. And I hope everyone is doing well and has a happy New Year.
Happy New Year to you. Thank you.
Thank you, Yulia.
Bye-bye.